10 cities, 1 pattern sellers are cutting price or hesitating. In this US Housing Market 2026 update, I'm going to show you 10 cities where home prices are falling fast, and the exact data signals behind each one. And make sure you watch until the end, because city number 1 is down over 6% year-over-year with some of the strongest falling signals in the entire country. This is not hype. We're using publicly available market data so you can verify everything yourself. Zillow market pages, Redfin price cut reports, and Freddie Mac mortgage rates, all sources you can check right now. Quick disclaimer: this is educational content, not financial advice. Real estate is local, and you should always double check with professionals in your area. But if you're buying or selling in 2026, recognizing these signals early can save you tens of thousands of dollars, or help you find the right opportunity at the right time. So here's what we're working with. We'll use 3 main data sources throughout this video. First, mortgage rates from Freddie Mac and the affordability mortgage rate series. As of January 23, 2026, the 30-year fixed rate is around 6.09%. That's important because even though rates have come down slightly from their peak, they're still elevated enough to impact affordability in a major way. When you're looking at a $400,000 home, the difference between a 5% rate and a 6% rate is roughly $340 per month. That's nearly $3,000 per year, and over 30 years, you're talking about $86,000 in additional interest payments. So these rate levels matter tremendously. Second, we're using market behavior data like price cuts from Redfin. In their August report, Redfin showed that 16.7% of listings nationwide had price drops, and some cities, like Denver, were as high as 31.1%. That's a massive signal that sellers are chasing the market down. When 1 in 6 homes nationally is showing a price reduction, that tells you the market is shifting from seller control to buyer control. And third, we're using city-level home value trends from Zillow's market pages. These give us clean year-over-year direction, are prices up or down, and by how much. When you combine all 3 of these sources, you get a complete picture of what's actually happening on the ground, not just what the headlines are telling you. Now, my ranking method today is straightforward. I'm looking at cities showing a mix of year-over-year price softening, price cut pressure from reports like Redfin, and clear buyer hesitation signals. This doesn't mean every single neighborhood in these cities is crashing. Real estate is hyper-local. But it does mean the overall market is repricing, and if you're active in these areas, you need to be aware of the trend and adjust your strategy accordingly. Alright, let's get into the countdown. We'll start with city number 10 and work our way to the number 1 market showing the strongest falling signals. Let's go. City number 10 is Houston, Texas. Houston shows up on this list because of the combination of affordability sensitivity and increasing competition. When mortgage rates sit near 6%, buyers in price-sensitive metros tend to slow down first. And that's exactly what we're seeing in Houston. Homes are sitting on the market longer, buyers are asking for more concessions. And sellers who don't adjust their expectations are getting stuck with listings that go stale. Houston has historically been one of the more affordable major metros in the United States. But affordability isn't just about the sticker price, it's about the monthly payment. When rates rise, payments rise, even if home prices stay flat. A buyer who could comfortably afford a $350,000 home at 5% might only qualify for $310,000 at 6%. That's a $40,000 drop in purchasing power. And it shows up immediately in buyer behavior. What you need to watch in Houston is price reductions and days on market. If those numbers keep moving up, prices will follow down. It's simple cause and effect. The action tip here is straightforward. If you're a buyer in Houston, this is your window to negotiate for credits, repairs, or outright price cuts. Don't be afraid to ask. If you're a seller, pricing correctly from day one matters more than it did 6 months ago. Overpricing and hoping the market catches up work in a repricing environment. You'll just sit on the market, and sitting costs you money and carrying costs and missed opportunities. City number 9 is Jacksonville, Florida. Florida as a whole has shown weakening in Zillow's data. The statewide typical home value is down year-over-year, and Jacksonville is feeling that pressure directly. One of the big reasons is higher insurance costs. Florida homeowners are dealing with skyrocketing insurance premiums, and when you add that to property taxes and a 6% mortgage rate, the monthly carrying cost becomes a real barrier for buyers. In some parts of Florida, homeowners' insurance has doubled or even tripled over the past few years. We're not talking about a small expense here, In some cases, insurance is adding $300, $400, even $500 per month to the total housing payment. And here's the thing: lenders factor insurance into your debt to income ratio when they're qualifying you for a loan. So even if a buyer can technically afford the mortgage payment, the insurance cost might push them over the threshold and disqualify them entirely. Why does this matter for Jacksonville? Because when carrying costs go up, buyers reduce what they're willing to pay for the home itself. It's not that they don't want to buy, it's that the math simply doesn't work. And when buyers pull back, sellers end up competing on price. What you should watch in Jacksonville is price cuts plus inventory. If both of those rise together, that's a clear downshift signal. And it means the market is repricing faster than most people realize. Jacksonville could see continued softness through the first half of 2026 if these trends persist. City number 8 is West Palm Beach, Florida. Florida markets became famous during the pandemic boom. People were moving in from high-tax states like New York, New Jersey, and California. Remote work was exploding and prices were climbing fast. But in repricing cycles, those same markets can cool just as quickly. Why? Because there's more investor activity and more relocation-based buying, which tends to be more rate-sensitive and more rate-sensitive than traditional owner-occupied purchases. When buyer demand becomes more cautious and listings start piling up, price reductions spread like wildfire. Redfin has shown multiple Florida metros seeing declines in certain reporting periods, and West Palm Beach is one of them. What you need to watch here is if new listings stay high while pending sales soften. When that gap widens, when supply is growing but demand is shrinking, sellers start cutting prices to stay competitive, and price cuts accelerate across the board. West Palm Beach also has a significant amount of luxury inventory, and luxury markets tend to be the most sensitive to economic shifts. High-end buyers are often discretionary buyers. They don't have to buy right now, so they wait for the perfect deal. And when enough of them wait, inventory stacks up at the top of the market first, and that pressure eventually filters down to the mid-market and even entry-level properties. Watch the luxury segment in West Palm. If it softens further, the entire market follows. City number 7 is Las Vegas, Nevada. Zillow shows Las Vegas home values down about 2.1% year over year. Now, Las Vegas is a classic boom-bust style market. It reacts quickly to credit conditions because it has a lot of investor activity, a lot of payment-sensitive buyers, and a market structure that moves fast in both directions. When affordability tightens, demand can cool rapidly. And when demand cools, prices don't stay flat. They adjust downward. Las Vegas was one of the hardest-hit markets during the 2008 housing crash. Prices fell by more than 50% in some neighborhoods. But it was also one of the fastest markets to recover during the post-2012 boom. That tells you something important about the psychology in Vegas. This market moves with momentum, both up and down. Right now the momentum is shifting to the downside. The key thing to watch in Las Vegas is the percent of listings with price drops. Because once sellers start cutting, the comparables reset quickly. And in a market like Vegas, where investor psychology plays a big role, sentiment can shift fast. If you're watching this market, track how many listings are showing price-reduced tags over the next 60 to 90 days. That will tell you whether this is a temporary slowdown or the beginning of a deeper, longer-lasting correction. My bet is on the latter, but we'll see what the data shows. City number 6 is Seattle, Washington. Zillow shows Seattle home values down around 2.1% year over year. Seattle is interesting because it tends to be highly payment-sensitive. Why? Because prices are already high. When you're talking about a median home price in the 700s or 800s, even a small rate increase makes a huge difference in the monthly payment. A jump from 5% to 6% on an $800,000 home can mean an extra $400 or $500 a month. And that's enough to push a lot of buyers to the sidelines. The reason Seattle is on this list is because of that high price point, combined with an affordability ceiling. Buyers simply can't stretch any further, so they wait. They wait for rates to come down. They wait for prices to come down. They wait for their income to go up. But here's the thing. Seattle is also one of the markets to watch for potential turning points. If mortgage rates drift down even slightly, or if tech hiring picks back up in a meaningful way, Seattle can stabilize faster than other markets on this list. So this city is both a risk and an opportunity depending on your timing and your strategy. If you're a long-term buyer and you can afford the payment, Seattle might offer value. If you're a short-term speculator, this is not the market for you right now. City number 5 is Orlando, Florida. Zillow shows Orlando down about 4% year over year on its market page. Orlando has a lot of move-in demand. People relocating for jobs at theme parks, hospitals, and the growing tech sector. You've also got retirees moving to the area and investors buying rental properties for short-term vacation rentals. But Orlando also has a lot of price sensitivity. When ownership costs rise, and we're talking mortgage plus insurance plus property taxes plus OA fees, buyers get cautious. They start running the numbers more carefully. They start backing out of deals that don't pencil out on paper. What you need to watch in Orlando is time to pending. If homes are taking longer to go from listed to under contract, that tells you buyers are hesitating. They're shopping around more. They're comparing more properties. They're waiting to see if sellers will drop the price. And when buyers hesitate, sellers cut to stay competitive and avoid going stale on the market. This is a market where the next 3 to 6 months will be absolutely critical. If inventory keeps rising and price cuts keep spreading, Orlando could see prices fall another 2 to 3% before stabilizing. That would put it down 6 to 7% from peak, which is a meaningful correction. City number 4 is Tampa, Florida. Zillow shows Tampa home values down around 4% year over year. The market is repricing because buyers don't want to stretch at today's payment levels. And remember, Florida's broader market is also showing decline, which adds pressure across the entire state. When the state-level trend is down, individual metros feel that momentum even more strongly. What you should watch in Tampa is inventory and price reductions. If reductions continue to rise, and right now they are, sellers lose pricing power quickly. And once pricing power is gone, the negotiation advantage shifts completely to the buyer. If you're buying in Tampa right now, you have leverage. Use it. Ask for credits. Ask for repairs. Ask for price cuts. The worst they can say is no, and in many cases they say yes because they need to move the property. If you're selling in Tampa, understand that your competition isn't just other sellers, it's also new construction, investor-owned properties that are being dumped, and buyers who are willing to wait for a better deal. You need to be priced right, or you'll sit. City number 3 is Denver, Colorado. Zillow shows Denver down about 4.2% year over year. But here's the bigger, more important signal: Denver also had one of the strongest price cut signals in the entire country. Redfin reported that in August 1% of Denver sellers dropped their asking price. That was the highest among the 50 biggest metros in that entire report. Let me say that again so it sinks in: nearly 1 in 3 listings in Denver had a price reduction. That's not a blip. That's not an outlier. That's a full-blown trend. The reason this is happening is competitive buyers pushing back plus sellers cutting to get deals done. And here's what happens next in a market like this. When price cuts become normal, appraisals follow. Appraisers use recent sold comps to determine value. And if those comps are all coming in lower because sellers had to cut their asking prices, the next round of appraisals will reflect those lower numbers. And that creates a feedback loop where each sale sets a new lower benchmark, which then forces the next seller to price even lower. Denver is a market where the repricing is already in motion, and based on what I'm seeing in the data, it's not done yet. Expect continued softness through spring 2026 at minimum. City number 2 is Phoenix, Arizona. Zillow shows Phoenix down around 4% year over year. Phoenix is another market that reacts quickly to affordability changes. It had a massive run-up during the boom years from 2020 to 2022. Prices in some neighborhoods went up 30, 40, even 50%. And now it's giving some of that back. When rates rise, demand cools. And when demand cools, sellers compete aggressively. The reason Phoenix is number 2 on this list is payment sensitivity, combined with a lot of recent price appreciation that buyers are no longer willing to pay for. Buyers are looking at what homes were selling for 2 years ago, and they're saying, why should I pay this much more when rates are higher and my payment is going to be significantly larger? And they're right to ask that question. What you need to watch in Phoenix is increasing days on market plus more price cuts. If both of those trends continue, and right now they are continuing, the market is still repricing, and there's more downside ahead. Phoenix could stabilize if rates drop significantly, or if there's a major influx of new job growth. But until that happens, expect continued softness and continued pressure on sellers. And now, city number 1, Austin, Texas. Zillow shows Austin down about 4% year over year. That's one of the sharpest drops on today's entire list, and it's why Austin takes the number 1 spot. Austin had a massive, historic boom. Tech companies like Tesla and Oracle moved their headquarters there. Remote workers flooded the market from California and other high-cost states. Prices shot up at a pace that was frankly unsustainable. And now the market is normalizing, and when you combine elevated mortgage rates with a shrinking buyer pool, sellers start competing aggressively on price. Redfin's broader reporting has also shown multiple major metros falling in certain periods, and large Texas metros like Austin are prominently part of that trend. The next 60 to 90 days in Austin are absolutely critical. If price reductions stay high and inventory continues to build, sellers will keep chasing the market down, trying to find the price point where buyers actually bite. This is not a crash in the traditional sense, but it is a correction. And for buyers, this is the opportunity. If you've been priced out of Austin over the past few years, this is your window. For sellers, this is the reality check. If you need to sell, price it right. If you don't need to sell, you might want to wait this out and see where the market settles. So those are your 10 cities: Houston, Jacksonville, West Palm Beach, Las Vegas, Seattle, Orlando, Tampa, Denver, Phoenix, and Austin. Each one is showing a combination of affordability pressure, inventory competition, and spreading price cuts. And each one is repricing in real time as we speak. Now here's what I want you to do. If you live in one of these cities, or if you're thinking about buying or selling in one of these markets, don't wait for the headlines to tell you what's happening. The headlines are always late. The data is early. By the time the news reports that a market has turned, it's already been turning for months. So be proactive. Watch Zillow's market pages for your city. Check Redfin's price cut percentages every week. Follow the local days on market trends. Track how long homes are sitting before they go pending. Because the market doesn't wait for you to be ready. It moves whether you're paying attention or not. And if you're not paying attention, you'll miss the signals. And if you found this video helpful, do me a favor, drop a comment below with your city and state. Tell me where you're watching from. I'll pick 10 cities from the comments and break them down in the next video with the same level of data and analysis. This is how we build a community that actually understands what's happening in real estate instead of just reacting to fear, hype, or whatever the latest headline is pushing. Also, if you're serious about tracking the US housing market in 2026, hit that subscribe button right now. I'm publishing weekly market updates, city-by-city breakdowns, and data-driven analysis so you can make smarter, more informed decisions. No clickbait. No doom and gloom. No fear-mongering. Just real data, real analysis, and real strategy that you can actually use. Thanks for watching. I'll see you in the next one.